pretty lovely good morning from here in Delhi, and hope as always that each one of you are keeping well, happy, and of course in fine spirits. So on such count, we today start this particular sessions, and lots of demand was being made by the student fraternity regarding the solutions of the June 2025 paper. And they want actually full solutions. So for the same actually now we are adhering to your demand and coming out with this particular session. So here is your June 2025 paper, syllabus 2022, corporate financial reporting. And as you know, your first question comprises of your MCQs, and each question carries 2 marks. So here is the first question. Choose the correct option from the 4 alternatives which have been given to you. So when the objective of holding financial asset does not include collection of cash flows, here the question is related to Ind AS 109, as you know better than I actually. And over there we have explained this concept as far as measurement of financial assets are concerned. And if you remember, when objective of holding the financial asset does not include collection of cash flows by selling the financial asset, then such financial assets are measured at. If you remember actually, I told you, if your intention is to sell the assets very frequently, in that case actually FVTPL is the category wherein you are going to measure. However, if your intention is to hold the asset for the time being and then sell it later on, in that case FVTOCI. But if your intention is to hold the asset, but your intention is not here to collect cash flows by selling the asset, that means you want to hold the asset till the maturity, and if your intention is to hold the asset till the maturity, then it is categorized under amortized cost. So here answer will be amortized cost. Is it clear to you or not? And further here in this particular case, the next question is related to Chairman of the Public Accounts Committee and Comptroller and Auditor General are appointed by. Now, this question is related to government accounting. For that, you must be thorough with the what we call notes, which we have provided, and also those among you who have gone through our regular classes, we have taken every theoretical chapter in great detail, and answer here will be what we call third one. Is it clear to you or not? Now, as far as third one is concerned, here it is given requires that when consolidated financial statements are prepared by the investor company shall prepare individual standalone financial statement which are named as separate financial statement. So question is asking, actually first of all you need to understand the meaning of the question, what exactly the import of the question here. So as far as import of the question is concerned, here question is asking you if there is an entity and it needs to prepare consolidated financial statement, which standard actually requires that when consolidated financial statements are prepared by the investor company could be a parent company, isn't it or not? And investor company shall also prepare individual. That means in that case, besides preparing the what we call consolidated financial statement, they need to prepare their standalone financial statement. So which particular standard has prescribed that? If you remember actually, when we took Ind AS 103 in the opening session itself, actually I talked at great length, and over there also I stress upon this particular fact that question could be tossed up from this particular part. So your correct answer is Ind AS 27, because Ind AS 27 says that whether you happen to be a parent company or whether you have to be an investor company and you are required to actually prepare the consolidated financial statement, then besides that, in that case, you will have to prepare your separate financial statements also. Is it clear to you? So that's the reason Ind AS 27 in this case will be the correct answer. Coming over to the fourth point, Pindari Limited changes its method of valuation of inventories from weighted average method to first in first out method, and the accountant opines that Ind AS 8 is applicable, and Pindari Limited should account for this change as. Now, if you have gone through Ind AS 8, and in fact recently, as you know, this particular series is going on, and out of 20 to 21 sessions have been taken, and over there we have talked at great length regarding what we call all the Ind AS, and even minutest of the Ind AS 8 have been taken with lots of practicals. And if you remember actually over there, I have mentioned it very categorically that in case if there is an entity and it changes the method of valuation of inventories, so in that particular case, the change will have to be accounted for retrospectively. So here, correct answer will have to be changed. It is a case of change in accounting policy, and it need to be accounted retrospectively. Coming over to the Fifth point, in fact, recently I have taken your what we call India series also, and under India 16 I have already covered this particular solution. Alaknanda Limited took an asset for 5 years from Mandakini Limited, for which relevant details are as under. Payment over the lease term. First of all, you need to understand that here you have taken the asset for 5 years. Is it clear to you? In the first year, how much your payment will be? Because it is clearly given that payment is 1,000 per month. That means each year you are going to pay 12,000 rupees. Correct? So, first year end, second year end, third year end, fourth year end, and fifth year end. So, total amount which you are going to pay will be equal to 60,000. Besides that, it is also given in the question that contingent rent. While taking Ind AS 116, both in revision and in our regular classes, I have already told that contingent rent will never ever be considered as a payment or for computing what we call lease liability. So contingent rent you are not going to take into account. Cost for services given by Mandakini Limited. So Mandakini Limited might have given some services, and for that you are paying an amount of 40,000. Again, it will not be taken as a part of lease liability. Taxes reimbursement will also not be considered. Residual value guaranteed by Alaknanda Limited was rupees 5,000. However, the fair value of the asset at the end of the 5 years is 6,000. Now, the point here is that we have given a guarantee of 5,000. Obviously, this will be considered for the purpose of lease liability, irrespective of the fact that at the end of the year, actually the residual value is 6,000. Fair value of the asset at the end of the 5th year means at the end of the 5th year, its actual residual value is 6,000. But we have committed to what we call give a guarantee. We have committed for a what we call guarantee of 5,000. So it will be considered this 5,000 amount. So here we are going to, that means total payment, of course, 1,000 into 12. So for 5 years, we are going to pay 12,000, so 60,000. And guaranteed residual value, 5,000, we are going to add also because it is considered as part of payment for computing the minimum lease payment. And further, it is given also Alaknanda Limited has an option to purchase the asset after a period of 5 years for rupees 2,000. Now, this is a new point, to be very honest with you. Now, here in this case, Alaknanda Limited, the lessee company, has been given an option that after the end of the lease tenure, you have the option to purchase this particular asset. Now, wherein lessor feels that there is reasonable certainty that this particular option is going to be exercised, in that case, it will also be considered for computing the minimum lease payment. And further, it is written actually that it is reasonably certain that Alaknanda Limited will exercise the option. So in this case, you are going to add this 2,000 also. And you can also refer India 16, which I have recently loaded. The last question over there, I have actually solved, and total amount will be 67,000, and over there I have given also lots of notes regarding this. Now coming over to the 6th point. So in this case, your correct answer will be 67,000 as I have already shown you. Now question number 6, C Limited acquired, even though this question is pretty simple, but chances are there that a student might commit actually some mistake. C Limited acquires 60% of N Limited for rupees 97,50,000. Now, it means your purchase consideration in this particular question is 97,50,000. Correct? 97,50,000, and you have acquired actually 60% of the stakes. The fair value, it is also given in the question that fair value of the identifiable net asset is 150 lakh. Now, net identifiable assets, it is given is equal to 150 lakhs. So 150 lakhs you are going to write first of all, correct? Now, out of that, as normally the format which we use to compute the amount of goodwill, out of net identifiable assets, first of all, I need to pluck out the asset which belong to NCI. Now, let me see actually how much of 150 lakh belong to actually NCI. For that, I will have to actually wait for a while, in the sense because how much asset belong to actually NCI, for that I need to know whether question is specified to use PSNA method, proportionate share of net asset method, or fair value method. The fair value of 40% of the equity share owned by non-controlling shareholder is 65 lakh. Now, in this particular question, the fair value of NCI is given. But Question says that carrying amount of N Limited's net asset is rupees 120 lakh. Actually, we are not concerned with this amount. See, actually, the book value or the carrying amount of the net assets of the N Limited is given to you 120 lakh. We are not concerned with this particular amount because we are more concerned with the fair value of the assets of the what we call other company. So in this particular says acquiring company's net identifiable asset is equal to 150 lakhs. So this information becomes irrelevant. Now see here. Calculate the value of the goodwill when NCI is measured as proportionate share of identifiable net assets. That means here in this particular question, you have to compute NCI on PSNA basis and not on fair value basis. Because chances otherwise there are very much bright that some of the students, the moment they are going to go through this particular line, that fair value of 40% of equity shares owned by what we call non-controlling asset, they may think actually that fair value is given, so immediately they will take 65 lakh as the asset belonging to the NCI. No. In this question later on is specify that you have to actually use the PSNA method. So I need to compute 40% of 150 lakh. That comes to actually 60 lakh. So we may say that out of 150 lakh, 60 lakh worth of asset belong to NCI and the remaining actually belong to acquirer company. So acquirer company's share in the net assets on the date of control will be considered as 90 lakh. Now this is acquirer shares. Now once we have the acquirer share, then we compare it with the amount of purchase consideration. And the amount of purchase consideration is given to us as 97,50,000. So in this case, purchase consideration exceeds the amount of net assets. So quite obviously the balancing figure will be your goodwill. That is 7,50,000 in this case will be considered as goodwill. So 7,50,000 will be your correct answer. Is it clear to you or not? In point number 7, it is given that Indian Government Accounting Standard IGAS to deal with. Now, those among you who have purchased what we call regular courses, they have already seen actually we give equal stress to both practical chapters and the theoretical chapters. And in detail, actually, we have explained all the standard. However, here the question is simply asking us what is the title. Actually, IGAS 2 deals with. So you need to know the title, and the title is Accounting and Classification of Grants in Aid. Now the next one, 8th one, here it is stated that an entity purchases a plant from a foreign supplier for $3 million on January 31st, 2025 when the exchange rate was 72 to $1. At the entity's year-end 31st March 2025 amount has not been paid. Now so far in this particular question actually what is being tossed up, let me tell you, your accounting year actually must have begun on 1/4/2025, 1/4/2024. I think it is 1/4/2000. It is given 31st of January. So on 1/4/2021, your accounting year must have begun and must have ended on 31st of 3/2025. And it is given that in the month of January 2025, to be precise, 31st of January 2025, you have purchased a plant. And you purchased a plant for $3 million, it is given in the question. And on this date, but on this particular date, your rate of exchange is $1 is equal to rupees 72. And at the year end on 31st of March, the amount hasn't been paid. Of course, the amount hasn't been paid and the closing exchange rate is given to you as $75. $75. The entity's functional currency is rupees. Okay, this entity's functional currency is rupees. So which of the following statement is correct? Now, first of all, you need to understand that on this particular date, when you are going to purchase the plant, you are going to pass an entry because we have done entire what we call Ind AS 21, and we have explained actually through entries also this concept, and we have covered this particular question over there quite well. So here in this particular case, your entry will be plant account debit to foreign suppliers account, or simply suppliers account. You can write this. There is no necessity. FS means foreign suppliers account. And so many times I have already told you, because you have done the transaction on January 25, so on this particular date, what exactly is the what we call rate? You are going to use that particular rate to translate it into your functional currency. Correct? Your functional currency is rupees. So $3 billion will be multiplied with rupees 72. Now, if I am going to multiply $3 million with rupees 72, I will get how much? Let me see actually. 72 into 3. That is equal to 216. So 216. At this value, you are going to record the plant and what we call your foreign suppliers. Correct? So on the date of the transaction, plant will be recorded at 216 lakh and also your foreign suppliers will be. Now at the end, this is the first question. Actually, question is asking you, the entity's functional currency is INR and which of the following statement is correct? The cost of the plant will be 216. As you know, I have told you, because it is a non-monetary asset. It is a non-monetary asset, and at the end of the year, we are not going to change the value of the non-monetary asset. Even at the end of the year, plant will be carried at this particular value. So this will be considered as the cost of the plant. However, when I am going to reach the end of the year, because now rate, as you can see, is now 75, so obviously my liability will increase. That means at the end of the year, the foreign supplier, because foreign supplier means the creditor, and creditor is a monetary item. All the monetary item will have to be recorded as per rates which are prevailing at the end of the year. So at the end of the year, I will have to multiply, now in this particular case, $3 million with rupees 75. Now, if I am going to multiply it with this, it will be equal to 225, I think so, 75 into 3, yes, it is 225. That means at the end of the year, your foreign suppliers will be recorded at this particular value. So that means your liability has increased, and your liability has increased by 9 million, million, because figures are given in millions. So that means this is a loss to us. So which of these statement is correct? So 216 million is the cost and exchange loss is 9 million and trade payable will be 225 at the end of the year. So this is your correct statement. Coming over to the 9th point, now in this particular case, let us see what is given to us. Consolidated financial statements are required to be prepared by an Ind AS complied company having sole control over the investee company. Now you tell me, actually, suppose if there is a particular company, let us say there is E1 and it is having complete control over the investee company, the other company you can call it. Now you tell me, do I need to here prepare the consolidated financial statement or not? Obviously, I'm having the full control. So whenever I'm having the control, I need to prepare the consolidated financial statement. Now, other point is significant influence over the other entity. Significant influence. Now, suppose there is E2 and you have got what we call, let us say, investment to the extent of 20%, but up to 50%. If your investment is 20% or more, but up to 50%, now it is categorized as a case of significant influence. That means you are this time exercising significant influence over the other entity. But still you will have to prepare the consolidated financial statement. If you remember in DS3 when we started, in the very first session I talked a lot about this. And similarly, joint control over the entity. Even this particular point I had explained. Suppose if I've got a joint control over the other entity, even in that particular case, I need to prepare the consolidated financial statement. So in this case, your answer will be all of the above. Is it clear to you or not? Now coming over to the next point, 10th one. Here it is mentioned, PUA Limited grants 100 equity share options to each of 4,000 employees. So first of all, in this particular case, you have how many employees? 4,000 employees, correct? 4,000 employees, and you are granting 100 options. You have committed to grant them 100 options to each of the employee. That means total option which you are going to grant will be equal to 4 lakh. Of course, there is a condition attached. The condition is that they will have to be in the service for the 3 years. Correct? This is also mentioned that they need to actually serve the organization at least for 3 years. Now, fair value of equity share option on the grant date is rupees 60. And nominal value is 10. We are not concerned with the nominal value. We are more concerned with the fair value. Now, question is simply asking us, what will be the remuneration in each of the year? Now, in this particular question, quite obviously, because the nominal value, here the fair value is 60, which is given to us. So in this particular case, all I have to do is to multiply 4 lakh with 60 lakh and then divide it by rupees 3 lakh. So in this particular case, I will get 24 lakh divided by 3, that will be equal to 80 lakh. So 80 lakh will be my correct answer. That means each year I will have to actually recognize an expense of 80 lakhs. Is it clear to you or not? So this will be your correct answer. Answers which have been written in bold are actually your answers. Now question number 11th now we come over to. Let's see what is given in this particular question. Now as far as question number 11th is concerned, here it is given that Mahi Limited and Pooja Limited amalgamated on 1st of January 2022. Now it is a case of two companies. If you have gone through business India's 103, we have covered even this particular portion and even this sort of question also. Now there are two companies this time. One is Mahi Limited, another one is Pooja Limited. These two companies have amalgamated and now there is only one company. That means it is a case of, technically speaking, amalgamation. So Mahi Limited and Pooja Limited, they amalgamated into a new company and the name of the new company is Maju Limited. Maju Limited. However, although both these companies are by mutual consensus now agreeing to amalgamate into a one single entity, but from the business point of view, from the accounting point of view, we may say that this new company has taken over the business of M1 Limited and this new company has taken over the business of what we call P Limited. From the accounting point of view, we may say that new company has taken over M1 Limited and what we call Mahi Limited is the M1 Limited and Pooja Limited. Is it clear to you or not? From the accounting point of view, we will have to interpret it in this manner. Is it clear? Now the next question is, a new company, Maju Limited, with shares of 10 each. Now whatever share capital it is having, one share is of rupees 10 each. The important point is that. Now the net assets taken over of Mahi Limited and Pooja Limited are 90.5 lakh and 97 lakhs. That means when Maju Limited took over Mahi Limited, the net assets of Mahi Limited were 90.5 lakhs and 97 lakhs respectively. 97 lakhs respectively. Now suppose if I take the ratio of net assets of both these two companies, why I'm taking the ratio I will let you know, but let me compute the ratio. 90 point, my calculator is not working. 90, this is big problem, 90.5 plus 97. That comes to 187.5. So this will be the ratio, isn't it or not? Ratio of net assets. So Maju Limited took over M1 Limited and P1 Limited and their net assets which are given to us is equal to 90.5 and 97.5. Now question says that total purchase consideration payable is 130 lakh. Now Maju Limited decided to give a purchase consideration of 130 lakh. Now the question in fact is asking, how many shares in Maju Limited will have to be issued to Mahi Limited? Actually question is asking this much. How many shares Maju Limited will have to issue? How many shares Maju Limited will have to issue to M1 Limited? But in order to know the number of shares, first of all, we need to know what proportion of the total purchase consideration is payable to Maju Limited, because this is the total purchase consideration. I have already told you, now you will have to presume that Maju Limited is taking over M1 Limited and P1 Limited. Obviously now the new company will provide the what we call purchase consideration. Now it is given in the question that total purchase consideration is 130 lakh. Now the next question is, what proportion of purchase consideration belong to M1 Limited and belong to P1 Limited? This is the question. So first of all, I need to actually segregate the amount of purchase consideration. So how can I segregate? This is the point. So 130 lakh is payable to both these companies. Name are pretty cumbersome for me to pronounce, Mahi Limited and Pooja Limited. Is it clear to you? So in order to segregate this purchase consideration, what you will have to do, you will have to take the ratio. In fact, I will have to first of all know the proportion of purchase consideration which belong to actually M1 Limited. Now for that, what I am going to do, 130 lakh into 90.5 lakh divided by 187.50. So this way round, now I will get the total amount of purchase consideration which is payable to M1 Limited. And similarly, you can find out the amount of purchase consideration given to P1 Limited, 130 lakh into 97 divided by 187. But we are not concerned with that. Now, once we know the amount of purchase consideration, all you have to do is to divide it by what we call 10 to know the number of shares which are being allotted to what we call this particular company, and you will get 6,27,467 shares. Is it clear to you or not? So this is how you are supposed to do this particular question. Now we come over to the next part here in this particular question. This is question number 12, and herein you are being given that the following information is available from EX Limited. Now here sales revenue is given to you as 1,055 lakh. What is your sales revenue in this particular question? That is given to you as 1055. 1055. Of course, figures are in lakhs. Purchase of raw material are also given to you. Now, as far as purchase of raw material are concerned, raw material purchases is equal to 530 lakhs. It is given. And then decrease in stock of raw material, work in progress and finished goods is rupees 25 lakh. This time, as you know, when we compute the total revenue, generally we add the changes in stock. However, this time change in stock is negative. So you will have to subtract this 25. So if we are going to subtract, so you may say that at this particular moment, your total revenue at this particular moment is equal to 1030, and from there on you are going to subtract the cost of bought in material and services. So purchase of raw material, you have purchased 530, and then besides that here printing and stationery are 35. You are going to add 35 lakh printing and stationery, and then auditor fee is equal to 5 lakh. You are going to take that into account. Rent, rates and other expenses are 10 lakh. Rent, rates and taxes is equal to 10 lakh. You are going to take that into account. However, wages and salary will not be taken into account. Why we are not going to take that into account? And in order to compute the value added, actually you need to find out the value added. Is it clear to you? So in order to find out the value added, first of all, you need not require to subtract all those expenses which are related to employees. Number one, wages and salaries are related to employees, as I have already told you. Similarly, anything which is related to government. Similarly, anything which is related to the owners. And similarly, anything which is related to the entities. You need not require to subtract all these things. Is it clear to you? So that is why wages and salaries will not be subtracted. Similarly, depreciation will not be subtracted, as you have seen. In case if you have gone through economic value added, we have already uploaded all the fast track courses on the YouTube. You need to go through that, wherein I have spoken about it, why depreciation is not added. It is a non-cash item. Any non-cash item means this is the part of the profit which has been extracted by the entity and kept by itself. So you are going to subtract only this much. So if I am going to add all these things, it will be equal to how much? Let me see, actually 530 plus 35 plus 5 plus 10. That comes to, according to my calculation, 580. So I will subtract 580 now from 1030 to see what exactly is the answer. 450. So your value added should be 450. Let me see, actually I haven't got the time to solve them earlier. I'm simply solving it right in front of you because I'm too busy. As you have seen, actually I'm busy with FR Hindi classes, FR English version classes, correct? Then similarly your CFR course, so I hardly get time. So anyway, fortunately 450 lakh is the correct answer. Why I'm saying fortunately? Not because I'm suspecting my ability, because sometimes I suspect the ability of the institute. It is nice to see that institute this time has come out with correct answers almost for every question. 13th, on 31st of March, a non-banking financial institution company has its advances classified as follows. So this question should not pose you much what we call difficulty. Standard asset, then substandard assets are given to you, and then a secured portion of doubtful debts up to 1 year is given and 1 to 3 year is given. All you have to know in order to solve this particular question at NBFC, you must have gone through what we call this particular topic provisions, where I have explained them at great length. So this question should be almost like a stroll in the park for you. All you have to know is to multiply them with the correct provisions. Is it clear to you? So you can easily manage this particular question. And similarly, as far as question number 16 is concerned, on 1st of January 2025, Shiva Limited entered into a contract with Kalpit Limited to sell 50 laptops. This question is related to Ind AS 115. And when I took Ind AS 115, recently we have uploaded it. Over there, I have already solved this particular question. So here we have they have entered into an agreement with the Kalpit Limited to sell 50 laptops at 50,000. So 50 laptops, contract is to sell 50 laptops with 50,000 per laptop as the price. And these goods were delivered in the month of February. In the month of February 2025, you have delivered the goods also, and your accounting year is ending on 31st of March 2025. Now, question says that determine the revenue to be recognized by Shiva Limited for the year 2024-25 means your accounting year is ending on this particular date. If 4 sets were found damaged at the time of receiving and hence returned, because out of 50 sets, 4 sets were found defective at the time of receiving these sets, indirectly it means net sets sold are equal to 46, and 46 into 50,000, this will be your what we call answer in this particular case. So by multiplying 46 with 50,000, you must get 23 lakh, and that should be your correct answer in this particular case. Is it clear to you or not? Coming over to the next part of this particular question, on 1st of April 2024, BM Limited acquired 90% of the share in CM Limited for rupees 10,80,000. Now this question is similar to the one which is contained in our study material. Almost every question was from our study material. I need not require to make very tall claims regarding that. But those among you who have already gone through what we call the study material in the regular classes, they know actually this question was almost there. So in this particular case, your accounting year is starting on 1/4/2024, and obviously it will end on 31st of 3/2025. Isn't it or not? Right, sir. And it is given that on this particular date, you acquired 90% stakes in CM Limited. CM Limited is the acquiring company. You are the acquirer company. And in order to acquire 90%, you churn out 10,80,000. So 10,80,000 is the amount which you have paid to actually got hold of 90% stakes. Further, it is given when you acquired the control on that date, the fair value of the net assets was 10 lakh. So fair value of net assets. So fair value of net asset is also given in the question, and that happens to be 10 lakh. That happens to be 10 lakh. This is also given in the question. Now, during 1/4/2024 till the end of the accounting year, now question says that CM Limited, which happens to be the acquiring company, made total comprehensive income of 2 lakh. Total comprehensive income indirectly means total profit earned by this particular company during the entire year happens to be 2 lakh. Is it clear to you? So on that date, BM Limited, now question says that on that date, that means at the end of the year, BM Limited sold 15% of the holding to the outsiders. So first of all, you need to know the amount of net assets on the net asset as at 31st of 3/2025. So in order to compute the net assets on 31st 3/2025, all you have to do is to take into account the net assets in the beginning, that is 10,80,000. And now, because you have earned a profit of 2 lakhs, so indirectly your net assets will increase. So we may say that at the end of the year, total net assets were equal to 12,80,000. 12,80,000 worth of assets were there. It is given in the, now we can actually find. Now, because we have sold 15% shares, I want to know the worth of 15% share. So worth of 15% share will be equal to 15% of 12,80,000. 15% of 12,80,000. Is it clear to you? This will give you the worth of your 15% holding. Now, for example, in this particular case, if I am going to compute 12,80,000 into 15%, that comes to 1,92,000 according to my calculation. 1,92,000. That means I have sold 15% of the shares. And problem is that I have sold 15% share and their worth is actually 1,90,000. Now the next question is, for how much actually we sold them out? We sold actual sale value. Now it is given that we sold them out for 2,20,000. So here I am going to write 2,20,000. And so on that date, BM Limited sold 15% of the holding for rupees 2,20,000. Now actually I have done it correctly or not. Let me check it here once again. Actually I have written here 10 lakh 80. Unfortunately it is 10 lakh. Extremely sorry. So 10 plus 2 is actually 12 lakh. Anyway, no problem, but the concept should be clear. So 12 lakh, 15% of 12 lakh will be equal to how much? 180, I think, right? So 1,80,000 is the worth. First of all, in order to know the worth of 15% share, I need to know the total amount of net assets of the acquiring company at the end of the year. In order to find out the total net assets at the end of the year, what we need to do is to simply add what we call the total amount of profit to the net, what we call identifiable assets in the beginning. So this will tell me the total amount of net assets now available at the end of the year with the acquiring company. So I will take 15% of that. It will tell me that what we call fair value of my 15% holding. And I have sold them for 2,20,000. So in this case, now you can say that 40,000 is your profit. Is it clear to you? This is how you are supposed to do this particular question. Correct? In this particular question, this is a part 2. As you know, from your part 2, you are supposed to do any 5 questions out of the 7 questions, and each question carries 14 marks. So here is the first question, and it has got 3 parts or 2 parts. Let me see actually. First of all, here it is written, Alka Limited has machinery at a cost of 4,80,000. Correct? And a provision for depreciation of 1,60,000 as at 1st of April 2022. So the remaining life of the machine is 6 years with a residual value of rupees 80,000. This is given to you. That in the beginning of the year, this particular entity is having 4,80,000 worth of machinery, and depreciation provided on it is equal to 180, and besides that the residual value is 80,000. This is given to you so far. Correct? And further, let me see what else is written. On the same date, one component of the machine is replaced. Now, on the same date, one component of the machine is replaced and the new component is rupees 60,000. Obviously, you are going to add this to the carrying amount on this because this has been done in the beginning itself. Now, the cost of the old plant was 50,000 with accumulated depreciation of 20,000. Now, the carrying amount of the old plant, the carrying amount of the old component, should I say, carrying amount of old component will have to be subtracted. Now the cost of the old component is 50 and the depreciation is 30. So you will have to subtract actually 20,000. In fact, sorry, this is 20,000. So 30,000 you will have to subtract. 50,000 is the cost, 20,000 is the depreciation. So the carrying amount of the old component must be 30,000. So that must be de-recognized now. Now this old component, which is having a carrying amount of 30,000, has been taken over by a supplier. Further question states that it has been taken over by supplier for rupees 36,000. Now there is a gain of 6,000. This gain will be separately recognized in a statement of P&L. On 31st of March 2023, that is at the end of the year, machine has been revalued at rupees 5 lakh. Now the main point here is that taking into account this particular information, first of all, you need to find out what we call depreciation at the end of the year. That means, first of all, you need to find out the carrying amount at the end of the year. Then in case if there is any upward revaluation, you are going to add it, and then you will get your revised carrying amount at the end of the year. And at the end of the year means 31st of 3/2023. Is it clear to you? So in this particular case, see here how you are going to do. On 1/4/2022, as I told you, cost of the machinery is 480 and the accumulated depreciation is 160. So your total carrying amount is equal to 3,20,000. Now at the end of the year, if I am going to actually provide the depreciation, what will be my depreciation? But before providing the depreciation, we must understand that in the beginning of the year, we have actually replaced it with a new component. So one component has been replaced. Whenever you are going to replace a component, it will always be capitalized. So the cost of the new component will be capitalized and the old component carrying value will be de-recognized. So we may say that carrying amount is 3,50,000. Now, if carrying amount is 3,50,000, now what will be my depreciation at the end of the year? See, 3,50,000 minus residual value and the remaining life is 6. So I'm going to subtract the depreciation 45,000. Now I may say that on 31st of 3, carrying amount is equal to 3,05,000. But question has also given that at the end of the year, machinery has been revalued at rupees 5 lakh. So if you are going to take the difference of 3,05,000 and 5 lakh, it will tell you by how much upward revaluation has taken place, that is 1,95,000. Now the point is that after revaluation, your carrying amount is 5 lakh. Now when you are going to reach the end of the year, that means next year, 31st 2024, what will be the amount of depreciation? Because now the carrying amount is 5 lakh, you will write 5 lakh. There is no change in the residual value. And now your remaining life will be 5 years because you have reached the end of 31st 2024. So at the end of 31st 2024, depreciation will be 84 and you are going to subtract it from 5 lakh to get 4,16,000 as the carrying amount. Further in the question, it is also given an impairment loss has taken place to the extent of 90,000. So you subtract the impairment loss and question has asked you now what is the carrying amount after the impairment. So after the impairment, the carrying amount will be equal to 3,26,000. Is it clear to you or not? So this is how you are going to do this particular question. Similarly, part B of this particular question, now it is stated that a machine was acquired by S Limited 15 years ago at a cost of 20 crores. And its accumulated depreciation as at 31st 2024 was 16.60. A machine was acquired by S Limited 15 years ago and at that time the cost was 20 crores. Now its accumulated depreciation is just wait. And its accumulated depreciation is actually 16.60. Further, it is written that depreciation estimated for the year 24-25 is 1 crore. Now, it is also given that you are estimating a depreciation of what we call for 24-25 equal to 1 crore. This is also given in the question. Estimated net selling price on 31st of March 2024. Now, it is given in the question that on 31st of March, on 31st of 3, 2024, correct? On 31st of 3, 2024, it is given that net selling price estimated is 1.20. Estimated selling price is going to be 1.20 and which is expected to be declined by what we call 20%. So that means by the end of the year, that means when you are going to reach the end of 24-25, this selling price will decrease by 20%. This is also given to you. Its value in use has been computed at 21.40 as on 1st of April. So 31st 3 2024 or 1st of April 2024, one and same date. Now question says that your value in use is actually 21.40 and it is expected to decline by 30% by the end of the next year. That means when you are going to reach the end of 31st 3 2025, the value in use will be 21 crore minus 30%. So this is the situation which is given to you. Assume that other conditions of relevant accounting standard for applicability of the impairment are satisfied and no impairment test was carried on 31st 3 2024. That means question is clarifying that on 31st of 3 2024 you did not carry out any impairment. Now, question says that what will be the carrying amount of the machine at the end of 31st of 3 2025. This is the first part of the question. Now, in order to understand that, first of all, you need to understand here on 1/4/2024, cost of the machine is 20 and 16.60 is the total accumulated depreciation. So quite obviously, I may say that 3.40 in this particular, there is no need for this bracket. 3.40 actually is your carrying amount. Is it clear to you? Now, it is clearly as given in the question that for the year ended 31st-3/2025, your depreciation is being expected at 1 crore. So, we may say that on 31st-3/2025, the carrying amount of the machinery will be equal to 2.40. No problem. Now, on 31st-3/2025, now I need to actually do the impairment testing. I will have to compute the impairment loss. In order to compute the impairment loss, first of all, I need to find out recoverable amount. Now, in order to find out the recoverable amount, as it is given that estimated selling price in the beginning of the year, that is on 1/4/2024, is 1.20. But by the end of the year, it will decline by 20%. So 0.24 decline. So that means the estimated selling price on 31st/3, estimated selling price on 31st/3/2025 will be equal to 0.96. Now I have to compare it with the value in use. Now it is given that value in use in the beginning is 1.4 and it is declining by 30%. So you subtract 0.42 from 1.40 to get 0.98. So we may say 0.98 is value in use. The higher figure between these two is 0.98. So your recoverable amount will be considered as 0.98. So what will happen? Now we are going to compute the impairment loss. So in order to compute the impairment loss, first of all, I will write the carrying amount which we computed here, 2.40 at the end of 31st/3/2025. Carrying amount is 2.40 and recoverable amount is 0.98. That is higher figure between what we call value in use and net estimated selling price. So 1.42 will be considered your impairment loss. Of course, your carrying amount will be, because before depreciation, your carrying amount was 2.40. 20.16.63.40, then depreciation, you can directly write here actually 2.40. Your carrying amount was 2.40 and now you simply subtract the impairment loss, correct? So your carrying amount will become 0.98. This is how you are going to compute the carrying amount. Now there is another what we call part of this particular question. First two answers I have already given. The first question is what will be the carrying amount of the machine as on 31st/3/2025, and second, how much will be the amount of impairment loss. We have already computed impairment loss as equal to 1.42, I think. Yes, this is your impairment loss and this will be your carrying amount. Carrying amount will be 0.98. So first two answers have been given. Now, as far as third is concerned, here it is written, if the value in use was 0. Now question says that on now what is the meaning of this particular question actually? Just wait. On 31st/3/2025, we have already computed the carrying amount. Carrying amount is 2.40. Now question says that now we are going to compare it with the recoverable amount. Now recoverable amount, as we know, is higher figure between value in use and estimated selling price. Now question says that if we presume that value in use is 0 and company was required to incur a cost of rupees 8 lakh to dispose of the plant, compute the carrying amount of the machine and impairment loss. Now question here says that if you are going to incur, now see here, point is that your value in use is nil. Now we were given that net selling price is 0.96, which we computed already. Now question says that because selling price has declined by 20%, so on 31st/3/2025, our selling price is actually this much, 0.96, which we computed earlier. Now question says that if we are supposed to spend further 8 lakh, so if I am going to convert 8 lakh into crore, it will be equal to 0.08. So that means now my net selling price will be equal to 0.88. On 1/4/2024 selling price was given. Then you have subtracted 20%. Selling price at the end of the year is 0.96. Now question says that if you are going to spend further 8 lakh, so it will reduce the selling price. Now the net selling price will be 0.88. So the point here is that now your selling price is actually 0.88. So that means your recoverable amount will be equal to 0.88. And now by taking into account the difference of these two, you will get the impairment loss. Is it clear to you or not? This is exactly how we have done it. So here you can see by subtracting what we call 0.88 and carrying amount is 2.40. So by subtracting you get the what we call impairment loss of 1.52. And of course your carrying amount will be equal to 0.88 because your carrying amount is 2.40. And if you are going to subtract the impairment loss, so ultimately the revised carrying amount will be equal to 0.88. This is how you are supposed to do this particular question. We have also covered, in fact, we have already covered this particular question. All these questions we have already covered, but just to make the point clear. Here it is given that on 31st of 3/2024, A Limited entered into a contract with a customer for sale of goods of rupees 20,000, granting 50% discount. Now recently I did Ind AS 115. I have already solved this particular question over there. So you can directly look into that particular the solution if you want in detail. So on 31st of 3/2024, A Limited entered into a contract for sale of a product to a customer for rupees 20,000 and tells that we will give you further 50% discount in case if you are going to buy 15,000 worth of goods within next 30 days. That means we are luring the customer that within next 30 days, if you are going to make purchases up to 15,000, not more than that. So if your purchases will be in the next 30 days, if your purchases will be in between 0 to 15,000, we will give you 50% discount. So when we sold the goods to the customer for rupees 20,000, we gave him a discount voucher, you can say actually, wherein we told him that if in the next 30 days you are going to make purchases up to 15,000, not more than that, we are going to give a discount of 50%. However, it is stated in the question 10% discount is allowed on sales. It is stated in the question that 10% discount is allowed on sales. Indirectly, it means whosoever buys goods from this particular entity, we ordinarily give him a discount of 10%. Ordinarily, discount will not be available to avail the 50% discount voucher. I have explained it under Ind AS 115 because we are already giving 10% discount, correct? So, and now we have told this customer that if you are going to buy in future within next 30 days, correct, goods in between 0 to 15,000, we are going to give you 50% discount. Now that customer cannot claim 50% plus 10%. That customer may say, you have given me a promise of 50% discount and you are already giving 10% discount, so give me a 60% discount. No, customer will not be allowed. This is the meaning of this particular sentence, that ordinary discount will not be availed to avail the 50% discount voucher. That means maximum discount which will be given to you will be 50% only. Now question says that there is 60% probability that the customer will redeem the discount. There is 60% probability that customer will redeem the discount. This is the most important point, and he will make estimated purchase of rupees 10,000. So we are estimating that in future, within the next 30 days, first of all, there are 60% chances that he will purchase the goods. Although he can purchase maximum 15,000 worth of goods, but we estimate that he may purchase up to 10,000 worth of goods. So first of all, till up to this particular point, I am going to solve this particular question. I have already solved this particular question. Correct? Under Ind AS 115, all the questions of June 2025 have been taken into account. So we have already solved that. We have already actually solved that particular question. Now kindly pay attention here. Now if you are going to have a look, and even under Ind AS 115, I have already told you, first of all, you need to trace out the obligations. Actually, there are two performance obligations in this particular case which the company will have to carry out. Because we have entered into a contract with the customer, the first obligation is that we will have to deliver him the goods. Now, it is given in the question that we entered into a contract for sale of goods worth rupees 20,000. But the point is that we are already giving 10% discount to the customer. So, even though the sale are 20,000, so customer will get 10% discount. That means goods have been sold to the customer for rupees 18,000. This is your first obligation. Now, the point is that what will be the amount of discount voucher, a discount voucher, because you will have to give him a discount. This is another obligation upon you. This is your second obligation. Now, how to find out the value of the discount voucher? I have already told you. For that, you need to take into account that how much discount you have given, 50%, but you will take discount as 40%. You will take discount as 40%. Effective discount rate will be not 50%, but 40%, because 50% you have promised and 10% you are giving to everyone. So effectively you have given to this particular customer in excess of 10%, only 40% discount. And chances are there that, and there are 60% chances that he may purchase, and we have expected that he is going to purchase 10,000 worth of goods. So this is how you are going to find out the what we call amount of discount voucher. 10,000 into, first of all, the amount of purchases will be 10,000, and 60% chances probability you will take into account, correct? Then how much purchases he is going to do, you will take that into account, and effective discount rate will be 40%. So 2,400 will be discount rate. Now, as I told you, you take the what we call ratio. So ratio will be 18,000 divided by 20,400 and 2,400 divided by 20,400. Is it clear to you? But you must not forget that your transaction price is 18,000, because at this moment you have sold him only goods worth effectively for rupees 18,000. So this is the transaction price at this particular moment. Now you will have to break this particular transaction price. So when you are going to break this particular transaction price between these two performance obligations, 18,000, now you apply this ratio which I computed. So you will get 15,882. Similarly, discount voucher 2,400 into ratio which I just computed, 2,118. So in this case, we may say that effectively in the current year, I am going to recognize a revenue of 15,882, and I am going to recognize a liability in the form of discount voucher to the extent of 2,118. So this is what exactly I have written here. Thus in 2022-23 revenue recognized will be 15,882, and at the same time discount voucher carrying a liability of 2,118, because you have to perform this obligation. Now, question further states that in April, that means at the end of the year, now next year will start, and in the month of April, discount vouchers were redeemed, and he purchased additional goods for rupees 14,000. Now, because in the next year, he has redeemed the discount, so your liability for discount voucher will get evaporated. So you are going to now recognize the discount voucher as revenue. Is it clear to you? Number one. And besides that, you are going to recognize, because he has made additional purchases and you are supposed to give him 50% discount, so 7,000 further you are going to recognize as revenue. So here I have written that in 23-24, this liability will be cancelled, that means discount voucher 2,118, and it will be recognized now as revenue. And further, the transaction price for the additional sale is 14,000 less 50% discount, so 7,000 further revenue you are going to recognize. That means the total revenue which you are going to book in the next year will be equal to 7,000 plus 2,118. That will be equal to 9,118. This is how you are going to actually do this particular question. Is it clear to you or not? Question number 3A, we have already finished. Now we are going to pick up question number 3B, and in this particular question, actually this is the balance sheet of Famous Limited which is given to you. And in the balance sheet, we are being given under non-current asset, property, plant and equipment to the extent of 10,92,000. And then we are being given what we call financial asset. When financial asset signifies actually your investments, and your investment are in 6%. Actually, this 6% is not printed over here. 6% government securities, and their face value is 2,80,000. Although in the outer column you have written 2,24,000, which signifies that you have paid actually 2,84,000 to buy government securities having a face value of 2,80,000, carrying interest of 6%. Then other non-current assets are 84,000. Under the current asset, you are being given inventories, stock in trade, taken at 90% of the market value. Actually, whatever is the market value, we do not know. But the question says that 90% of the market value is equal to 6,30,000. Is equal to 6,30,000. That means this value at which we have written stock, this is 90% of the market value. Suppose if you were to find out, or if you are If you, due to some reason, had to find out the market value, in that particular case, you will have to find it in this manner, 6,30,000 into 100 by 90. So you can find out the market value also. But this is 90% of the market value. Then under the current asset, we have a category of financial asset, and under the financial assets, we are being given trade receivable and then cash and cash equivalent, and the total amount is also given to us. Besides that, equity share capital 11,20,000, along with that some note is also given. We will read the note later on. And then other equity total is 9,24,000. Again, it is carrying a note. And trade payables are 2,94,000 and provisions are 3,36,000. And here it is written current tax. That means you have made the provision as per your current taxes. So whatever current rate of taxes are prevailing in the market, as per that you have created the provision. This is what we mean by that. Now equity share capital it is now clarified that you have 11,200 equity shares of 100 each, 11,20,000. And as far as other equity which is given in the balance sheet at a figure of 9,24,000, question says that out of that actually general reserve is 4,20,000, and then you had retained earnings in the beginning 1,68,000. That means your net profit balance in the beginning was 1,68,000, and in the current year you have earned a net profit of 3,36,000. If my net profit after tax, as it is given here, if my net profit after tax is 3,36,000, and it is stated in the balance sheet, that we have created a provision for tax as per current rates, and the provision for tax which is given to us in the balance sheet, as you can see, is also 3,36,000. Indirectly, it means your current rate of tax is 50%. Is it clear to you or not? And the total of this is 5,04,000, and then by summing up 420 and 5,04,000, we have 9,24,000. Now, in the very first line, it is given to you that property, plant and equipment has been understated by 6,72,000. What does it mean? Whatever your property, plant and equipment in the balance sheet is given, first of all, you are going to add 6,72,000 to that figure because it is understated by 6,72,000. So we will have to increase it. And then question says that the property, plant and equipment have also suffered a further depreciation of 2,80,000. That means a further decline of 2,80,000. So you are going to subtract 2,80,000 to the value. So that way around you can get the what we call revised value of property, plant and equipment. Then it is also stated that the companies doing similar business as that of Famous Limited are earning a market rate of 10% on capital employed. I need not require to tell you, this is your normal rate of return. Profits over previous 3 years have been increasing by 70,000. What does it mean actually, profits? It means if we are going to consider the profits of the last 3 years, question says that profit is showing an increasing trend of 70,000. What repercussion it is going to have later on while solving the question that I am going to let you know in a short while. And here it is written that for valuation purpose, stock is to be considered at market value. That means you will have to trace out the market value, and at that time I told you this is how you are going to derive the market value. 6,30,000 into 100 by 90. Is it clear to you? Now, in this question, your current year is 2024-25. You will have to start with the current year. Your current year is 3,30,000. Your current year's profit is 3,36,000 after tax. And it is stated in the question that in the last 3 years, we have seen that profit is increasing by 70,000. Now, suppose I am going to subtract 70,000 from 3,36,000. Obviously, I am going to get 2,66,000. That will be previous year's profit. And the profit previous to 2023-24, if I want to know, I will have to subtract 70,000 from 2,66,000, so I can get 1,96,000. And our tax rate, as you can see, 50% is given. So whatever our net profit will be there, obviously my tax provision will also be same. So that way around, I can get my net profit before taxes. So net profit before taxes are 3,92,000, 5,32,000 and 6,72,000. This is the first step which you need to actually do. Now, in the question, it was given that you have invested in the government securities also carrying an interest of 6%. So when you are going to compute the interest, you need to take care that interest must be computed on the face value. I need not require to remind you at this level. So your face value is 2,80,000. If you are going to take 6% of that, that will be equal to 16,800, 16,800. Obviously, it's a non-trading income. I have already told you And in my regular classes, I've already told you that if nothing is mentioned, always presume that it's a non-trade investment. Whereas several other reasons I have also cited over there that how you can find out whether it's a non-trading investment. Just allow me a second. It seems some lagging is going on. I think it's okay. Am I audible? Right. So I was talking about this particular fact that 2,80,000 is your investment, 6% is rate of interest. Quite obviously, your investment are non-trading. So you are going to subtract 16,800. So now you can see that your adjusted profit will be equal to this much. Is it clear to you? Now, in this particular question, actually one point, you can take simple average. I'm not going to stop you because I have already told you the chapter goodwill is something which is very subjective. Right in the beginning, when I started in my regular sessions, this particular chapter, I told you it's a pretty subjective thing. So if same question will be solved by 100 people, there is every chance that you may get 100 different answers. But the point is that if there is a rule that if profits have shown increasing trend, it is always better to consider a weighted average profit. Is it clear to you? So that is the reason in this case, first of all, I will write these profit before taxes. I will take the weights as 1, 2, 3. Then I will multiply with weights, correct? And then I am going to divide it by 6. Total of the weight will be equal to 6, 1, 2, 3. So I will take the weighted average. Is it clear to you? I have taken weighted average because in this particular case, the profit, it is stated in the question that profits are increasing by a particular margin. So if profits have shown a particular uniform increasing margin, in that case, it is always better to consider your weighted average instead of simple average. Is it clear to you? So total weighted profits are this much. You divide it by weight. Weight is 6. So you will get what we call weighted average profit equal to 5,61,866. You can consider these profits. This is your weighted adjusted profit before taxes. Is it clear to you? So now, because you have computed your weighted average profit or past adjusted profits, now you will have to subtract the tax at the rate of 50%. So your future maintainable profit will be equal to 2,80,933. You can take the approximate figure. So 0.334 here I have also written. Now, because we have the future maintainable profit and we need to find out the goodwill at 3 years purchase of what we call normal profits, super profits. So I need to find out first of all capital employed. In order to find out the capital employed, I will take all the assets, correct? But I will not take into account goodwill. I will not take into account non-trading asset, as I have already told you so many times. So property, plant and equipment, as I told you, you will have to add 6,70,000 and subtract 2,80,000, and then trade debtors at 5,32,000 and stock in trade at proper market value 6,30,000 into 100 by 90, and then your cash and cash equivalents. So total assets will be equal to this much, and then your total as far as your liability side is concerned, trade creditors are 2,94,000 and provision for tax is 3,36,000. Total of liability is equal to this much. So if you are going to take the difference between the assets and liability, it will give you what we call your capital employed. So your capital employed will be equal to 21,98,000. Now, once you have the capital employed, you can find out the normal profits. So your normal profit will be equal to 21,98,000 into 10%. That is equal to 2,19,800. And then you are in a position to find out your super profits, your future maintainable profits. You have already computed. Now you have to subtract your what we call normal profit, 2,19,800. You will get normal super profits equal to 61,133, and finally you can find out the amount of goodwill. 3 into 61,133, that will be equal to this much. But some of you may think our answer is not matching with the suggested answer. I've already told you goodwill is something which is subjective, correct? It is not necessary that everyone will get the same answer. However, you will still get the full answer even in case if you are going to solve the question this way around. However, there is a alternative way of solving the question. Instead of taking the average capital, normal capital employed, we can take the average capital employed. We can take the average capital employed. Actually, to be very honest with you, whenever we take weighted average profit, whenever we consider weighted average profit under such circumstances, it is always better to consider average capital employed instead of simple capital employed, as we call it closing capital employed. Is it clear to you? Now, we have already computed capital employed. Now, if I am going to subtract 1/2 of current year's profit, 1/2 of current year's profit, 1/2 of current year's profit. When we say current year's profit, it should always be after taxes. Is it clear to you? So if I am going to subtract from the capital employed 1/2 of current year's profit, I can get the average capital employed. I can get the average capital employed. See here what I have done. Total assets we have seen, total liabilities we have seen, our capital employed was 21,98,000. Now here I have subtracted my current year's profit is 6,55,200 before taxes. Now if I am going to apply 50% tax rate, so this profit will become net profit after taxes, and I will take 1/2. I have already told you 1/2 of net profit after taxes of current year. So ultimately, if you are going to subtract net 1/2 of current year's profit, which will be equal to 1,63,800, you will get the average capital employed. Now, once you have the average capital employed, now you can find out the normal profit by multiplying your normal rate of return with the average capital employed. In that case, your normal profit will be equal to this much. And obviously, your super profits will change. Now, your super profits will be equal to 77,513. And ultimately, your goodwill will be equal to 2,32,540. And this time, your answer will strike with the what we call institute's answer. So you need not apply to worry on that particular count. But the point is that in case if sometime you have to take the weighted average situation, weighted average profits, and weighted average profit should be taken when profits show actually some increasing trend. So if you are taking weighted average profit, in that case, my advice is that it is better to take the average capital employed. Is it clear to you or not? So this was your question number 3. Now we take question number 4a. In this particular question, and this question is from financial instrument, and we did lots of questions, and even when I did in the class, and in the revision both, financial instrument chapter, I told you only this is the topic where you can expect a question, correct, where you need to segregate the initial proceeds into what we call equity element and the debt element. Here it is stated that D Limited issued 2,000 convertible debenture on 1st of April 2022, and debenture have a 3-year term and are issued at par with a face value of 1,000. So you have issued 2,000 debenture with a face value of 1,000, and obviously, so 2,000 into 1,000, your initial proceeds will be equal to 20 lakh. And interest is payable annually at a nominal interest rate of 6%. And these debentures have been issued for 3 years period. Further, it is written that each debenture is convertible at any time up to maturity into 25,000 ordinary shares of 210. So each debenture is convertible into 25,000. I think it is 5,000 or 2,000 sometime. Actually, there may be a case of printing mistake. Okay, do not worry about that. We are not going to concern up with this. So point is that these debentures are convertible into 25,000. You kindly check whether it is 25,000 or 5,000 as per your original examination question paper, because when we type actually with some printing mistake may take place. So anyway, 25,000 shares of 210 each. This is the situation. Point is that we have given an option to the debenture holder this time. We haven't given the option. Rather, it is stated in the question that these debentures is convertible at any time up to maturity into what we call equity shares of 210 each. When debentures are issued, the prevailing market rate of similar debt without conversion is 9%. And we are charging how much interest? We are charging, our coupon rate of interest is 6%. However, you can see that market rate of interest is 9%. The holders of the debenture holder elected to convert the debenture into equity at maturity. Now, examine the liability component and equity component, pass entries in the, and also it is written, also find out finance cost and also pass general entries in the books of D Limited for 3-year term. Of course, narrations are not required. You are also being given present value at the rate of 9%, correct? So present value at the rate of 9%, this should be present value of 1. I think it is 5,000 debentures. So present value of rupee 1, you are being given at the rate of 9% for all the 3 years. Is it clear to you? So this question should be a cakewalk for you. See here. First of all, you will write what we call 3 years pattern, correct? And now you will have to think in the 3 years, what exactly from the perspective of the entity, because you are the entity, what you are supposed to pay. Obviously, you have issued 20 lakh worth of debentures, isn't it? So on 20 lakh at the rate of 6%, you are going to pay interest each year And when you are going to reach the final year, you will have to pay 20 lakhs. Is it clear to you or not? So that means your total payment in this case will be 120, and in the third year, 21 lakh 20,000. Now you multiply these outflows with the respective what we call present value factors. So you can finally get this particular value. So this is nothing but your fair value of liability component. Is it clear to you? So present value of outflow. This is your present value of outflow, and it is nothing but this will be considered your present value of liability. So on the initial date, your total proceeds are 20 lakhs, and you are going to bifurcate them into now liability component, and whatever balance is there, that will be what we call considered as equity component. Is it clear to you or not? Now, how to compute the finance cost? I have already told you it's pretty easy. Actually, you can take the opening balance. You have recognized the liability at 18,48,156. Now you are going to compute the amount of interest. I told you at that time while taking my regular classes and also while taking the revisionary sessions, that whenever you are supposed to compute the interest rate, correct, for the purpose of computation of finance cost, do not forget actually that you will have to apply the market rate. The market rate is 9%. Now, while actually your interest expenses for the current year is 1,66,334 as per market rate, but actually you have made a payment of 1,20,000. So that means your liability actually is increasing by 46,334. So increase in liability. So your opening balance of liability is this much. You simply add this figure, you can get the closing balance of the liability. And in similar fashion, you can compute the what we call interest for the second year and third year. Now, how to write the entry? Obviously, on the initial date, you are going to receive 20 lakh. And you are going to write convertible debenture, write in bracket actually liability component. Again, you write convertible debenture, write in bracket equity component. This is the entry on the initial date. Now, entry regarding interest expense. Don't forget that you are the entity. Your total expenses for the current year will be considered 1,66,334. But the point is that you have paid only 1,20,000 because you are supposed to pay at the rate of coupon rate. Correct, 1,20,000. Outflow is 1,20,000. So that means the balance portion will increase your liability. So you are going to write convertible debenture and so on. This way you can write the entries. So this way around you can do this particular question now, and we come over to the next question. This is part B of question number 4. This is part B, and this part B is a little bit tougher in comparison to the earlier question. Let's see. Actually, this question is from your business combination in AS 103. I think so. Let me go through the question first of all. Correct? And let's have a look. The summarized balance sheet of J Limited as on 31st of March 2025 is as follows. It is given here. And in the balance sheet, you are being given property, plant and equipment, tangible asset with a note attached. Tangible assets are 40 lakh. Then intangible assets are also given 1 lakh 50. Total property, plant and equipment is equal to 41 lakh 50,000. Then under the current asset, we are being given inventory. Then under the current asset, there are financial assets. And under the financial assets, we are being given trade receivable and loans and advances. Total is equal to 1 lakh. And then similarly, equity and liability is given to us. As far as equity and liability is given, share capital 35 lakhs, some note is given. Similarly, other equity is also given. Actually, I think this question is from internal reconstruction. I think this is actually, that's the reason. This is internal reconstruction question, not what we call business combination question. Because negative balance is given also here. So other equity balance is 16 lakh 35. So your total equity is 18 lakh 65,000, share capital plus other equity. And some note is also attached with respect to other equity, we will see later on. Then long-term borrowing, again a note is also attached. Then short-term borrowings, again a note is attached. Then trade payables, so total 11 lakh. And 49 lakh 65,000 is the amount. Now coming over to the notes. Now we come over to the fact that as far as share capital is concerned, authorized, issued and fully paid, there are 20,000 equity share of 2,100 each. And besides that, we have 15,000 8% preference shares of 2,100 each. So as far as share capital is concerned, now we come to know actually we have both classes of share, both types of share, equity and preference. And coming over to other equity, so under the other equity, it is stated that there are retained earnings in the form of profit and loss account with a negative balance of 16 lakh 35,000. And then we have long-term borrowings. Actually, long-term borrowing now it is signifies here that 8% A debentures secured by assets of Bihar property and 9% B debentures secured by assets of what we call Karnataka property. But the point is that we have issued 8% A debenture, of course, as a security, and similarly 9% B debenture also as a security. What does it mean? It means when we have issued 8% A debenture, that means we have told to the debenture holder that in case if we would fail to honor our commitment with respect to what we call repayment after a specific period of time, in that case you have the right to sell our assets of Bihar Factory Limited. Similarly to these debenture holder, we have given a security that in case if we would fail to honor our commitment, then you will have the right to what we call sell off our assets of Karnataka Factory Limited. But both, in fact, you simply take them as 8% debentures and 9% debenture, and your total long-term borrowing is equal to 20 lakhs. Now, under the short-term borrowings, you are being given accrued interest on debentures, and bank overdraft is also given, and total amount is 5 lakh. Now we come over to this particular fact that as far as tangible assets are concerned, total tangible assets are 40 lakh, but it is given that property, plant and equipment of Bihar factory and property, plant and equipment of Karnataka factory. Our entity might be having what we call factories in Bihar and Karnataka. So property, plant and equipment of Bihar is equal to 20 lakh and property, plant and equipment of Karnataka is equal to 20 lakh. And now intangible assets are also given to you to the extent of goodwill and trademark. So this is the question. Now it is stated that following a scheme of internal reconstruction was framed. Of course, this question is of internal reconstruction and all the concerned parties have implemented. The preference share to be written down to 25. It's a simple entry. I need not require to tell you. Your preference share earlier is of 100 as it is given below in the question. Isn't it or not? Below it is given that your preference share capital actually is of 100 is not 2,100. Sometimes this figure of 2 unnecessarily comes when we type the things from the examination because there are some coded language. So when you simply scan it and type it, actually sometimes complete figure is not there. Actually there are 20,000 shares of 100 each and 15,000 shares of 100 each. Correct? Now, your share of 100 is being reduced to 25. Obviously, there is a gain as far as preference share is concerned, first of all, number one. And similarly, your equity shares, an equity share 2/5 each. Your equity share capital is also of 100 each. And equity share is of 100 each and it is reduced by what we call, in case of preference share capital, it is stated that it has been reduced to 25. So there is a gain of 75 per share. In case of equity share, it is stated that 2/5 each. So there is a gain of 95 as far as equity share is concerned. Further, it is stated that each class of shares then converted into shares of 100 each. Obviously, first of all, you will have to pass the entry for the reduction. And once you have passed the entry for the reduction of the share capital, then whatever your preference share capital is there, then you simply divide it. I will show you by way of entries so that you can understand it better. First, I have written this entry, 8% preference share capital account. My preference share capital is 15 lakh. Now, preference share capital has been reduced to 25 each, so 3,75,000. And reconstruction, obviously, I will transfer the balance. Correct? 15,000 into what we call 15,000 into 75. Now, similarly, I will write the next entry with respect to equity share capital. Now, equity share capital as per what we call information is 20 lakh. So if I'm going to divide 20 lakh by 100, I may say that we have got 20,000 shares of 100 each. And now the equity share capital has been reduced to 5 each. That means 20,000 into 5, that is equal to 5 lakh. And there is a heavy gain of 20,000 into 95. That is why 19 lakh will be transferred to reconstruction account. Now, later on, the question states that preference share capital has been converted into share of where each class of share then converted into 100 each. Each class of share then converted into 100 each. What does it mean? You can see actually after reduction, my share capital is 3,75,000. So 3,75,000 divided by 100. So I will have to write this entry, 8% preference share capital of 25, 3,75,000. This time there will not be any gain. Only thing is that there will be change in number of shares. Earlier we have got 15,000 shares of 25 each. Now, in order to know, once I am going to convert them into 100 per share, so indirectly it means now we have 3,750 shares of 100 each. Is it clear to you? Now, 8% preference share capital has been converted into 100 per share. First it was reduced and then again it has been brought back to 100. Is it clear to you or not? Similarly, your present equity share capital is 1 lakh. Now you divide 1 lakh by 5. So you know now that what entry you are supposed to pass. Equity share capital 1 lakh at this moment. Now you write equity share capital. So 1 lakh divided by 100. That means now you have 1,000 shares of 100 each. Is it clear to you? So this is with respect to what we call equity share capital and preference share capital. Now it is given that B class debenture holders decided to take over assets of Karnataka factory at a valuation of 7,50,000 in part repayment of their holdings. Now if I am going to have a look over B class of debenture. Now B class of debenture, which is given here, 9% B debentures are worth rupees 10 lakh. First of all, you need to understand this much only. And now you need to find out the amount of Karnataka factory. Amount of Karnataka factory is given to you as 20 lakh. Amount of Karnataka factory is equal to 20 lakh. Now let's see actually what is written in the adjustment. In the adjustment, it is written that B debenture holders decided to take over assets of Karnataka factory at a valuation of 7,50,000 in part repayment, not in full settlement, in part repayment. First of all, you need to understand that your Karnataka factory was taken over at 7,50,000 only. And if you have gone through my revisionary sessions or what we call my regular classes, as you know, actually, first of all, we need to actually pass the entry for revaluation loss in this particular case, because your Karnataka factory has been valued only at 750, so there is a loss of 12,50,000. Your entry will be reconstruction account debit to Karnataka factory, and this is what you need to write here. See here, reconstruction account debit to property, plant and equipment of Karnataka factory, 12,50,000. This time your reconstruction has been debited. Is it clear to you or not? Now, your next entry will be because the factory, Karnataka factory, has been now taken over by the debenture holders only for 7,50,000, but not in full settlement, in part settlement. So what will be your entry? We have done lots of such questions in the class, isn't it? Your next entry will be 9% B debenture account. You will debit them only by 7,50,000 because their account has been settled only on, it's a payment on account. It's a payment on account means their account will still be carried. That means still there is a balance of 2,50,000 in the B debentures. So this is the entry you are going to write with respect to this particular adjustment. Further, it is given in the question that debenture holder agreed to waive off accrued interest in full. Now, in the notes, you were given accrued interest, and accrued interest was 85,000. Now, it is written that it has been waived off. It is a gain to you. So, accrued interest on debenture 85,000 to reconstruction account. Correct? And further, here it is written that stock 50,000 are to be written off, 12,500 to be provided for bad debts. Profit and loss account balance, trademark, goodwill are to be written off. And do not forget to write off your retained earning negative balance. So first of all, you need to find out what is the balance in the reconstruction. So wherever reconstruction has got credited, you simply add it, and wherever it is debited, you simply subtract the same. You will get the net reconstruction balance. Then you will write according to the what we call directions of the question. It is given in the question that you need to actually write the inventory by 50,000. And then you need to create a provision of 12,500. Then direction was with respect to what we call your goodwill and trademark. And now you have to write off your what we call other equity negative balance. And then finally you will get a balance in the form of capital reserve to the extent of 12,500. Is it clear to you or not? So we are going to pick up this particular question. Tista Limited manufactures and sells car. And company wants to foray into the two-wheeler business. That means, and foray means want to make a forced entry, you can say. Instead of simply using the word entry, we use the word foray. That's the difference between foray and entry. The company wants to foray into the two-wheeler business, and therefore it acquires 30% interest in Mahananda Limited. Now, this is the parent company, as you can see. Just allow me to zoom it a wee bit. So, In this case, as you can see, that this particular company, Tista Limited, want to enter into two-wheeler business and it acquires 30% interest in another company. Is it clear to you? So Tista Limited acquired 30% interest. It is given to you that you acquired the interest on 1st of February 2025. And here you actually acquired 30% interest and you paid rupees 5 lakh for the same. How much amount you have paid? You have paid 5 lakh for the same. And an additional 25% stake on 31st of March 2025 at its fair value. By the end of the year, that means on 31st of 3 2025, you acquired additional 25% stakes in this particular company to the extent of 5 lakh again. Again, you paid 5 lakh rupees. Now, it is a case of business combination, correct? Do you understand? I told you when we did India's 103 over there, I mentioned this particular point that from this particular topic, business combination achieved in stages. This is a case of business combination achieved in stages. Is it clear to you or not? Achieved in stages. So, because when you acquired 30% stakes at the time, you were not having the control, but you were having the significant influence. But on the last day of the accounting year, this will be considered as your date of control. This will be considered as your date of control. Now, indirectly, it means in this particular question, entire accounting year will become your pre-acquisition period. There is no post-acquisition period because you have acquired the control on the last day of the accounting year. So at the end of the year, now you have 55% stakes in total, 30% plus 25%. But important point is that, if you remember, and I will talk about that particular point, first of all, you need to understand that it is a case of business combination acquired in stages. Number one. Technically, when we get the control on 31st of 3 2025, if you remember, I have told you actually we need to find out the fair value of our previously held investment. This 5 lakh will become my previously held investment. Is it clear to you or not? Anyway, here it is written, first of all, even for additional stakes, you paid 5 lakh rupees. The summarized balance sheet of the two companies given to you, and in the summarized balance sheet, you are being given property, plant, and equipment of both the companies. This is your parent company. This is your what we call acquiring company, subsidiary company now. And further, it is written under the asset side, financial assets. The investment in Mahananda Limited, that is equal to 10 lakh. Investment in Mahananda Limited is equal to 10 lakh. Obviously, your investment is now equal to 10 lakh because 5 lakh you paid earlier, 5 lakh you have paid now. An investment in corporate bond is equal to 4 lakh. Actually, don't get confused. This is normal investment by your acquiring company or by your subsidiary company. They might have actually invested some amount in the corporate bonds. So don't get confused by that. And then under the current asset, there are financial assets. And under the financial asset, we have trade receivables. And then we have cash and cash equivalent also. This is total of the assets. And then we are being given equity share capital 5 lakh, 1 lakh. Other equity 15 lakh and 5 lakh 50. Long-term borrowings are 4 lakh. Under the current liability, just to confuse you, they are writing financial liability and then actually trade payables. And now below it is stated that Mahananda Limited sells the motorcycles under the brand Moving Star. So the company which we are taking over now or acquiring the control of, that particular company is selling some motorcycles by the name of Moving Star, and which has a fair value of 3,50,000 as at 31st of March 2025. As this is a self-generated brand, therefore Mahananda Limited, the acquiring company, has not recognized the brand in the books of the account. But you remember, when we started India's 103, I told you, correct, it could be a possibility the company which you are acquiring might not have recorded some assets. But if you are taking over that particular company, those assets will have to be recognized by you, that means the parent entity, provided they satisfy the definition, required definition of the required standard. So we presume that This self-generated brand, which hasn't been actually recognized by your acquiring company, we presume that it is satisfying the parameters of Ind AS 38, correct, which deals with intangibles. So, on that basis, now we will have to recognize this. Now, it is a sort of unrecorded asset for you. It is a sort of gain for you now. Is it clear to you? Further, it is also given for the purpose of acquisition, fair value of the following assets of Mahananda Limited is estimated as under. Now, their investment which were appearing in the books, they have invested some amount in corporate bonds, as I was talking about here. Where is the corporate bond? That is 4 lakh. Now it is given that its value is actually 5 lakh and the property, plant and equipment's value is actually higher now, 7 lakh 50,000. Is it clear to you? So, this is also given. Then book value of other assets and liability of Mahananda Limited represents the fair value. That means whatever value which are being given in the books are at fair value. Past journal entry to give effect to the business combination in accordance with Ind AS 103 as at acquisition date, which happens to be the last day of the accounting year. Also prepare the balance sheet after the business combination. NCI is measured at fair value. Now this is given almost at the end and the question is of 14 marks. Is it clear to you or not? Now in this particular question, the first thing which you are supposed to do, if you have done what we call that particular part, this question should not pose you much difficulty. Now first of all, you need to understand that we have purchased 25% share initially, as I was talking about here. We have purchased 25% share at the end of the year, but prior to that, actually, we got 30% share. No doubt, we made additional investment on this particular date. So on this particular date, I may say that we acquired 25% share and we paid an amount of rupees 5 lakh. This 5 lakh in technical sense can be made as additional consideration, because we have already given them 5 lakh rupees when we acquired 30%. So this is, from our perspective, will be considered as additional consideration. Is it clear to you or not? Anyway, the next point is that, first of all, what you are supposed to do, in fact, first of all, you need to find out, as I told you, because you have some earlier investment and your earlier investment are worth rupees 30%, worth 30% and you paid 5 lakh. So first of all, on the date of control, you need to find out the fair value. Correct? You need to find out at the end of the year what is the fair value of your previously held investment. But how you are going to find it out? In order to find out the fair value of your previously held investment, first of all, you need to know actually what is your additional investment and what are your additional stakes. Your additional stakes are 25% at the end of the year. And for acquiring 25% additional stakes, you have paid 5 lakhs only. So if I want to compute the what we call fair value of my previously held investment, how can I find? I can find it this way around. See, at the end of the year, I may say for 25% stakes, the fair value is 5 lakh. So what will be the fair value of 30% stakes? So fair value of 30% stakes, you can now find it out. And this is how I have find out here. So you can find out 6 lakh. Now you come to know that your previously held investment now is equal to 6 lakhs. So obviously there is a gain with respect to what we call change in fair value of your previously held investment. And if you have gone and if you are going to actually revisit, you are going to that particular topic, you will find that this is a gain for you and you will have to write an entry, investment account debit to profit or loss account 1 lakh, 1 lakh. This is the first point which you need to understand. Is it clear to you that that is how the gain will be computed? I have written your gain amount will be equal to 5 lakh. Is it clear? Second important point is that now we have to find out, because our total stakes in the company is equal to 55%, obviously NCI share will be equal to 45%. Isn't it or not? Our total stake at the end of the year is 55%, so NCI stake will be 45%, and the problem is that in this particular question, they have specified that NCI is to be valued on fair value basis. Now we have to find out the fair value of NCI. On similar logic, you can find out. See, because you have to do everything at the end of the accounting year, in fact here at the end of the accounting year, in the sense that means on the date of control. Your date of control is at the end of the year, and on the date of control we just saw that in order to buy 25% share we have to pay 5 lakh. So we will consider this 5 lakh is the latest fair value. Is it clear to you? That is at the end of the year. For 25%, the fair value is 5 lakh. So what will be the fair value of 45%? We can easily find out the fair value this way around. So this is how the calculation I have done over here, and you can see your fair value will be equal to what we call 9 lakh. So NCI stake is 45%, and that is how we have found out the fair value of the NCI. Now we know that we have found out the value of the NCI. Now we need to find out the amount of goodwill. Now, in order to derive the amount of goodwill, what you are supposed to do, just wait. In order to derive the amount of goodwill, first of all, actually, let me also make it clear, because generally we have a habit of doing the solution in this manner. First of all, generally we used to write the dates, analysis, etc. Obviously, in this particular case, your starting date will be considered as 1/4/2025. Your end date used to be 24, and your end date is 31/3/2025. Is it clear to you? The controlling ratio or degree of control in this case we have already seen now is 55% and 45%. This is how we used to solve the question, isn't it or not? Isn't it? This is how we used to solve the question. After that, now I am going to take into account point number 3. Here I am going to make an analysis table. If I am going to prepare the analysis table, generally the purpose of preparing the analysis table is to know the net identifiable assets of the subsidiary company or the acquiring company on the date of acquisition. And for that, what we need to do, actually, we used to write share capital. In fact, we write share capital and the share capital of what we call acquiring company. Now, in this particular case, share capital of acquiring company is given to us as 1 lakh and other equity is 5,50,000. So I'm going to write here 1 lakh. 1 lakh is the amount of share capital. Is it clear to you? Generally, under the second point, we write pre-acquisition equity. Pre-acquisition other equity. Now, in this particular question, whatever other equity is there in the balance sheet, that will be considered as pre-acquisition equity, because we have acquired the control on the last day. Try to understand my point. Because the balance in the other equity on the last date is equal to 5,50,000. There is no opening balance. So entire amount which we have earned in this particular year will be considered as pre-acquisition. Reason being is that there is no post-acquisition period. Entire period is pre-acquisition period. So this entire amount will be considered as pre-acquisition equity. Is it clear to you or not? So 5,50,000 will be your pre-acquisition equity, and that is why you are going to write over here 5,50,000. However, in this particular case, now I will take into account fair value changes. Fair value changes or revaluation, whatever you may like to write. Now, it is given in the question that property, plant and equipment has gone up by 4 lakh, because if you are going to have a look over here, property, plant and equipment, which is given in the balance sheet, is equal to 3,50,000. And of course, your investment in corporate bond is 4 lakh, and below it is given that property, plant and equipment has been valued at 750, and investment in corporate bond has been valued at 5 lakh. So we may say that 350 and 750, 4 lakh and 4 lakh and 5 lakh. So there is a gain to the extent of 4 lakh here in case of property, plant and equipment. And besides that, there is a gain with respect to your investment in corporate bonds to the extent of 1 lakh. And don't forget, there is another gain in the form of brands. And because the entity which I am taking over hasn't recognized this particular asset, brands, because it is a self-generated asset. But if we are acquiring any acquiring company and it has got some asset which it hasn't recognized, we are going to recognize it provided they satisfy the criteria as laid out in 38. So on the presumption that these brands are satisfying the criteria, I will have to record it. Now it is a sort of unrecorded asset for me. So entire amount of 3,50,000, because it is stated in the question that brand is having a value of 3,50,000. So if I am going to add them, it will be equal to 8,50,000. So we can easily find out the total. If I am going to total them up, it will be equal to 15 lakhs. So we may say that on the date of acquisition, total net identifiable asset is equal to 15 lakh. Is it clear to you or not? Of course, now I am in a position to find out what we call respective shares of NCI and also of what we call acquirer company. Now, the next step generally after this we do is to actually compute the amount of goodwill. And in order to compute the amount of goodwill, first of all, we take into account the total net assets, which in this case happens to be 15 lakh. Isn't it or not? Now, we have already computed NCI. And NCI at fair value, we computed is equal to, what was the amount? I think 9 lakh. So we computed, and here we have computed 9 lakh. So NCI at fair value is 9 lakh. It means on the date of acquisition, whatever net identifiable assets of what we call acquiring company are there, out of that 9 lakh worth of asset belong to actually NCI. So we may say that acquirer share will be equal to 6 lakhs only. But because, so acquirer share is equal to 6 lakhs, correct? Now, normally in order to compute the goodwill, what we do is simply we take the difference between the acquirer share of net assets and we compare it with the amount of consideration. But the problem here is that it is a case of business combination achieved in stages. Now, what I have to do, first of all, I need to write here my previously held investment. And because we made previously held investment to the extent of 5 lakhs, so we may say that here, out of 6 lakh, 5 lakh worth of assets are accruing to us on account of our previously held investment. And now, that means only 1 lakh worth of assets are accruing to us on account of additional investment. Is it clear to you? And for the additional investment, we are making a payment. That means the consideration, it is given in the question that we are making a payment of 5 lakh. On account of additional investment, we are getting what we call hold of only 1 lakh assets and we are making a payment of 5 lakh. So quite obviously, it means there is a goodwill of 4 lakh. This is how actually I have done it over here. First of all, let me tell you the entire scenario. Generally, we have a habit of computing this way around the net assets on the date of acquisition, that is share capital 1 lakh, then other equity 5 lakh 50, and as I told you, revaluation gain because of property, plant and equipment, corporate bonds and brands. So total gain is 850. So 15 lakh will be what we call my total net identifiable assets on the date of acquisition. Is it clear to you? And out of it, we can say that NCI share, because NCI is based this time on fair value, we have already computed that 9 lakh. And as I told you, acquirer share will be equal to 6 lakhs. Acquirer share will be equal to 6 lakh. Is it clear to you or not? This is how. In this particular question, you can compute net asset this way around also, because the date of control is at the end of the year. If date of control is at the end of the year, you can compute it this way around also. You can simply take all the assets at the end of the year, correct? Including self-generated what we call brands. So total assets is equal to this much, and you simply subtract the liability, you can still get the same value. Is it clear to you? Now, in order to compute the goodwill, as I told you, first of all, I am going to write the net identifiable asset, and then I will pluck out the share of NCI. I will be left up with the what we call share of the acquirer. But out of this 6 lakh, as I was talking about, 5 lakh worth of assets are accruing to us because of our previously held investment. So that is the reason, on account of additional investment, only 1 lakh worth of assets are coming to us, and we are paying for additional investment 5 lakh rupees. That is why there is a goodwill of 4 lakh. Is it clear to you or not? So once you have found out the goodwill, these are the entries which you need to pass: investment account, debit to profit and loss account for the gain because of change in fair value of your original investment. And then whatever assets you are acquiring, you debit the same, correct? These are the assets which you are acquiring, and this will be your balancing figure. First of all, you cancel your old investment. Your old investment in Mahananda Limited, as we call it, previously held investment, its fair value now is 6 lakh. So you cancel it. And now you write 2 consideration, then you write 2 trade payables and 2 NCI, take that balancing figure 5 lakh. This is how you are supposed to do this particular question, and easily you can prepare the balance sheet now. Your property, plant and equipment will be equal to 21 lakh, correct? And similarly, goodwill will be equal to 5 lakh. Brand name will also appear in the balance sheet now, and even brand name is considered as a tangible asset. Then financial asset, investment in corporate bonds, that is equal to 5 lakh. It is written because you have taken over their investment now. Is it clear to you or not? So, and And here it is written current asset, financial asset, trade receivable 1,30,000, cash and cash equivalent, then your equity share capital will be equal to 15 lakh. And as far as other equity is concerned, your own equity is actually 15 lakh. And this time there is no share in post acquisition, because on the date of control, we are preparing the what we call balance sheet. Is it clear to you? Number one. And date of control is at the end of the year. So what about this 1 lakh? This 1 lakh is the profit on investment, the first entry which we have written. Is it clear to you? So your equity will be equal to 16 lakh, and then rest of the things you can write to get what we call your solution. Main point here in this particular question, because we have a habit of moving this way around, so that is why, in order to make you understand, we have adopted our approach and made it compatible to the what we call given solution. Is it clear? Now we are supposed to do the question which you are waiting for. So now we are going to pick up this particular question number 6, and this question is related to Ind AS 110 consolidation. I need not require to remind it, and we have done lots of such question in the classes, in the revisionary sessions, also in the regular session. Obviously we do lots of questions. So here S limited, and you are being given non-current asset, and under the non-current asset, property, plant and equipment, investment in S limited. Obviously there will be no investment in S limited column. And then we have been given inventories, and then trade receivables including due from S limited is given to you as 200. That means your H limited is claiming that we have to receive 200 from what we call H limited. And here cash and cash equivalent is also given to you. Besides that, equity share capital at the end of the year of both the companies are given, and figures are in lakhs. So rupees 7,500 lakhs, we have to keep track of these two items. So often I keep on telling, correct? So 7,500 and what we call 11,250 is the what we call balance in other equity. Coming over to the next point here, as far as current liabilities are concerned, 12506250. However, S limited is claiming that we are supposed to pay you only 150 lakhs. Now below here, it is given that on 1/4/2024, in the beginning, S limited had issued 7,500 lakh shares of 10 each. Now S limited had issued on 1/4/2000, in fact it is not given issued, okay, issued word is written, had issued on 1/4/2024 750 lakh shares of rupees 10 each. So that means their total share capital in the beginning of the year must be 7,500, and the closing balance is given as 7,500. Moreover, whatever closing balance is there, obviously that itself will be the opening balance, as we know. So this is quite an irrelevant information. Is it clear to you or not? However, the information relevant is that it is also given that on 1/4/2024, the balance is 7,500 lakhs in the retained earnings. Now, as far as retained earnings are concerned of S limited, in the beginning there is a balance of 7,500 lakhs, and closing balance is given in the question as 11,250. So 11,250 is the closing balance which is given to you. Correct? Further, it is given that aggregate and identifiable net assets of S limited on 1/4/2024. So on 1/4, before that, it is also written that on that date, 80% shares of S limited have been acquired through issuance of 12,500 lakh shares. So this time the purchase consideration has been delivered by way of shares. Another important point on 1/4/2024. Now question says that on 1/4/2024, there was property, plant and equipment, and there was inventory also. Whatever assets subsidiary companies having out of those property, plant and inventories is standing in the books at 8750 and 1250. Obviously, this will be considered as book value. However, it is also given that having a fair value of 9,500 and 500 lakhs, and their fair value now is also given to us as 9,500 lakhs and what we call 500 lakhs. So, as far as property, plant and equipment is concerned, we can say that there is a fair value gain of 750. However, in case of inventory, there is a loss of 750. So, ultimately, there is no fair value gain. But another important point given to us is rate of depreciation on property, plant and equipment is 10%. Now, because the rate of depreciation is given in this particular case 10%, and the value of property, plant and equipment is rising by what we call 750. So depreciation for the post-acquisition period, or additional depreciation as you call it, will be equal to 75. Further, it is given in this particular line, point number 3, that NCI is to be measured at fair value. So in this particular question, you have to keep track of this particular fact that NCI need to be measured at fair value. And then goodwill impaired by 100 lakh. Goodwill impaired by 100 lakh. So first of all, you are going to compute the amount of goodwill in a normal manner. And then whatever impairment losses is there, you subtract it from goodwill, and the net value of the goodwill will be reflected in the consolidated balance sheet. And this 100 lakh, the respective shares of what we call NCI and the holding company, will be subtracted from their respective claims. In point number 5, it is written, actually, what is written in point number 5, I am explaining here. Here it is written that H Limited has sold 300 lakhs worth of goods to S Limited. Obviously, it is a downstream transaction. First of all, you need to understand. Number 1, just to confuse you, it is also written that out of 300, only 250 lakhs worth of goods have been received by S Limited. Indirectly, it means 50 lakhs worth of goods are still in transit. But at this moment, we are not concerned with that particular fact. The fact is that we have sold 300 lakhs worth of goods. Even though some of the goods are still in transit, but sooner or later they are going to reach S Limited. So point is that we have sold 300 lakhs worth of goods. Now it is given out of 300 lakhs worth of goods, 40% of goods have remained unsold. And we are more concerned with the unsold goods, as you know. So if I am going to compute 40% of 300, that will be equal to 120 lakhs. And also it is given in the question that when H Limited is selling the goods, it is charging 25% profit on cost. So if you are going to convert the rate into selling price, it will be equal to 25 by 125. So 120 are the unsold goods, and then you are going to apply here the rate 1 by 5, that is 25 by 125, it will give you 24. So 24 will be your unrealized profit, and unrealized profit, as you know, actually will be subtracted in the consolidated balance sheet from inventories. And later on, when you are going to compute the consolidated P&L, you are going to subtract 24. That means entire amount of 24 will be subtracted from holding company's part. Is it clear to you? Because it is a case of downstream transaction. Coming over to the last point. Last point is related to dividend. And I have already told you, as per Ind AS, now dividend paid will be treated in a different manner, unlike what we call, as we used to do under AS 13 earlier. So under Ind AS, as far as treatment of dividend is concerned, first of all, it depends upon the fact when you have acquired the control. So if the control has been acquired in the beginning of the year, the first treatment is that you are going to add to during the year profit. Whatever profit you have earned, you are going to add it to during the year profit. And then you are going to compute the respective share of holding company and NCI, and you are going to subtract it from what we call their respective claims. Very simple treatment. However, if you have acquired the control after the beginning date, in that case, the dividend first of all will be added to the closing balance, and this treatment will remain same. The respective share will be subtracted. Is it clear? It is very simple treatment. Coming over to the last point, 7th point. The directors of both the companies have proposed a dividend of 10%. I have very clearly given in my classes that if proposed dividend is given only in additional information, no treatment is needed. You are not going to do any treatment. However, you can reflect this one by way of note under contingent liability. How you are going to reflect, I will show you also. Now I will solve the entire question as we normally do in the class. For example, we have a habit of first of all writing analysis of accounting period of subsidiary company. So as usual, you are going to analyze it, beginning date, your closing date. Now, your beginning date itself is the date of the acquisition. So your entire during the year period will be considered as the post-acquisition period. Then we have a habit of writing degree of control, although it is not needed, but just to make the point a little bit clear. Total number of shares of subsidiary company 7,500 lakh divided by 10, 750 share. And we have acquired 80%, that means 600 share, and 20% will belong to NCI. Obviously, your ratio will be 4:1, and moreover, in this particular question, actually, it is straightway given 80% share you have acquired. coming over to the next point, analysis of other equity. Now, as far as analysis of other equity is concerned, here you need to be a little bit cautious that we have to write the closing balance first of all, and we know that closing balance 11,250 of subsidiary company is given in the balance sheet. Now we have to compare it with the opening balance. As I told you, your opening balance in the retained earning happens to be 7,500. Now you take the difference of these two. The difference of these two will tell you the profits which you have earned during the year, and the difference will be equal to 3,750. Now, as I told you, because in this particular question, subsidiary company has paid a dividend of 20%. So 20% of what? 20% of opening share capital. And opening share capital is 7,500. So 7,500 into 20%, total dividend paid 500, you are going to add to during the year profit. So your total during the year profit now will be considered at 5250, and now you are going to bifurcate them into pre-acquisition profit and post-acquisition profit. Now, because in this particular question, entire length of the period is post-acquisition, so nothing is there in the pre-acquisition, entire amount will be transferred to post-acquisition profits. So we may say that entire profit which we have earned in the year will be considered as having earned in the post-acquisition period. So your post-acquisition profit will be considered 5250. Now, this is fair value change, which I have already told you that inventory is 1250, its fair value is 500, there is a decline. And property, plant and equipment, your book value is this much and fair value is this much, there is a gain. So ultimately, you are not having any net gain. Now we move over to the analysis table. The basic idea of preparing the analysis table, as I keep on telling in the regular classes, is to actually compute the net identifiable assets of the subsidiary company on the date of acquisition. For that, we need to take into account the share capital. On the date of control, the share capital is 7,500 of subsidiary company. Then here we write other equity, but we write other equity in the beginning. The other equity in the beginning is 7,500. Besides that, we also write here any pre-acquisition other equity, but problem is that in this particular question, there is no pre-acquisition equity. So we may say that 15,000 was the total equity or net assets of the subsidiary company on the date of control. Correct? But here, don't commit this mistake that total assets are 15,000. So immediately you should start what we call computing 80%, 20%. Because I've already told you that whenever NCI need to be computed at fair value, never bifurcate them in their respective shares. So first of all, you need to find out the NCI. Now, fair value of NCI, how you can find out? As we know, actually, we have acquired 80% control. And for 80% control, we are paying a consideration of 12,500. And the respective share of NCI is 20%. So what will be the fair value? So this way around, you can find out the fair value that is equal to 3125. Now you know that the fair value of NCI is 3125. Indirectly, it also means that out of total net assets of 15,000, 3125 worth of asset belong to NCI. So the remaining net asset will belong to the parent company. Is it clear to you or not? Now coming over to the post-acquisition other equity. As we just computed that post-acquisition other equity is 5250, and out of that our share will be 4,200 and 1050 will belong to what we call NCI. Now, additional depreciation, because the value of property, plant and equipment is rising by 750 and rate of depreciation is 10%. So additional depreciation 75 as a negative figure, you are going to write it, and respective shares are 60 and 15. Then after generally having computed analysis table, we go for computation of cost of control or goodwill, you can say so. In order to compute that, all we have to do is to simply write the respective share of parent company in the net assets on the date of acquisition, which we have already computed. So parent share in the net assets on the date of acquisition is 11,875. And now we have to compare it with the amount which we have paid, that happens to be 12,500. So actually your goodwill is 625, no doubt about that. But the point is that there is an impairment loss of 100. So this goodwill you are going to reflect 525 ultimately in your balance sheet. Is it clear to you? Now coming over to the non-controlling interest. Now in order to compute the non-controlling interest, here you have to exercise a bit of caution. First of all, share of equity at the date of acquisition. On the date of acquisition, share of equity, as we have already computed 3125 is the share of NCI on the date of acquisition. Now post-acquisition share we computed as 1050. I will show you 1050. Then we are going to subtract the additional depreciation also. Importantly, the share of dividend you must not forget to subtract. Total dividend is 7,500 into 20%, 1,500. And the respective share are 80% and 20%. So NCI share will be equal to 300. You are going to subtract. And don't forget to subtract what we call goodwill, impairment loss, I mean to say. Impairment loss is 100 and 20%, 20 you are going to subtract. Now the point is that in this particular question, now kindly pay attention. Actually, there is a fair value loss. There is a fair value loss in inventory. There is a fair value loss in inventory. Fair value loss in inventory, and fair value loss in inventory actually we computed earlier is equal to 750. No doubt about that, there is a fair value loss. But point is that because actually this is an alternative treatment, you can ignore it or you can use it. It is up to you. Correct? Fair value loss. Many accountants actually think because inventory is a current asset and in the period it will ultimately be exhausted. So because ultimately it will be exhausted, indirectly it means it will be realized. Is it clear to you? If it will be realized, there is no point in what we call taking into account their fair value loss. So many accountants are of the opinion actually that it should be reverted back. So in case if you want to revert it back, always write a note in the examination that inventory loss has been reverted. So if inventory loss has been reverted, what does it mean? It means now your profit will move up. So that is why reversal of inventory will increase the profit, and this profit will move to both holding company and what we call NCI. So the reversal of inventory fair value loss I have written here, 750 into 20%, 150. So ultimately your total amount of inventory will be equal to 3,990. Is it clear to you or not? And then unrealized profit, I have already told you, it is a case of downstream transaction, total remaining goods 300 into 40%. So 120 are the remaining goods. Rate is 25 by 125 on sales. So your unrealized profit will be 24. This is not an upstream transaction. So it will not have any impact in what we call NCI. Is it clear to you? So this is how you are supposed to do. And rest of the things you can do it by yourself, property, plant and equipment of parent company, then what we call your subsidiary company. And because there is a fair value gain of 750, you write 750, then don't forget to subtract what we call 75. So 35,175 will be the net value. Goodwill 625, impairment loss 100. So goodwill you are going to reflect at 525. Inventory is 12,500, 2,000. Then in this particular case, first of all, you need to take care that whatever goods which are still in transit will be added back, because ultimately these goods will reach in the hands of what we call subsidiary company, isn't it or not? So you will have to add 50, and unrealized profit 24 you need to subtract. So 14,526, trade receivable 2,500, 875 and 200. Is it clear to you or not? So you are going to write here 3,175 and cash, simply add it. You are going to get 19,500. So 72,901 will be your balance sheet total. Now equity share capital. Actually, we know that in the consolidated balance sheet, we write equity share capital of parent only. Actually, parent's equity share capital is 10,000. Are you getting my point or not? It is given in the question that parent's equity share capital is... where is the question? Parents' equity share capital was, it is given here 20,000. Is it clear to you or not? Parents' equity share capital 20,000 is given, and you know that we have to write only parent share capital in the balance sheet. So, and moreover, this point, you know, actually, why I have written 10,000, it is 20,000 already given in the question. Is it clear to you or not? But here, don't commit this mistake, because I have seen many a time a student commit this mistake. This share capital is given to you at the end of the year, and you acquired control in the beginning. And when you got the control, you paid the purchase consideration through issuance of 12,500 equity shares. So many students sometimes blindly they are going to add here what we call number of share issued by subsidiary company. Don't commit this mistake, because whatever shares which you have issued, those shares must have been taken into account, because in the balance sheet this amount is given 20,000. So here you are going to write only 20,000. Is it clear to you or not? This is important point. Try to understand that. Coming over to the most important part, consolidated P&L. When we write consolidated P&L, first of all, so often I keep on telling, take into account the other equity item of the parent company in the balance sheet, that is 43,750. Now, we will take into account post-acquisition share. Out of post-acquisition profit, our share was 4,200. Then I need to subtract the dividend share. Total dividend is 1,500, 80% will be 1,200. I will subtract that also. Then share of depreciation, don't forget to subtract 60. Total depreciation was 75. Then don't forget to subtract unrealized profit 24. In this question also don't forget to subtract your impairment loss share. And the most important part is reversal of inventory. In case if you are treating inventory loss on the presumption, you are reversing it on the presumption that inventory has been realized, then you will have to actually take into account that you have already taken share of what we call NCI. Now you will take the share of parent company, 750 into 80%, that will be 600. So your net amount will be 47,186. And then rest of the things you are going to do. Now coming over the trade payables, 1,250, 625. First you are going to subtract 200, but later on you will come to know that we are supposed to pay only 150. So that is the reason you are going to add back what we call 50 here. Again, indirectly you are subtracting 150, but this is the way to reflect. So 1,600, so total amount 72,900 will be reflected in the balance sheet. Now coming over to the proposed dividend, actually no treatment needed, but in contingent liability you can reflect it in this manner. Now, proposed dividend is generally computed at the end of the year, whatever your share capital, because it is proposed for the next year. So 20,000 is the share capital of the parent company, and both the companies have declared proposed dividend. So 20,000 into 10%, 2,000, this is the dividend, proposed dividend of the parent company. And share capital of S Limited is 7,500, 10%, 750. We are not concerned with the what we call amount of dividend proposed by the parent company. In fact, we are concerned only with this proposed dividend proposed by subsidiary company. Now, whatever dividend proposed by subsidiary company, we are going to take into account our share. Our share will be equal to 600. And out of 750, if I am going to subtract 600, so net dividend is 150. Net proposed dividend is 150. So 2,000 plus 150 will be equal to 2,150. This will be your net contingent liability. We call it net contingent liability, or you can simply add it or subtract this one. Is it clear to you? This is total proposed dividend by both the companies, and then you subtract the amount of dividend which you are supposed to receive from what we call H Limited. So this is how you can show it by way of note. So this was the question which was demanded by almost every student. And there is another question here, question number 7th. And rest of the question, actually, I am going to reflect it. In fact, you can do all these questions because there is hardly anything, to be very honest with you. And because these are theoretical questions, ABC, only one question is there with respect to your computation. And this question is straight away taken from our material with the same figures. Question number 7th A. Is it clear to you? And what else is remaining? These are theoretical notes. And is there anything for me to actually do something in this particular question? At least one question you can manage. So because I'm too tired, and in case if you want solution of this particular question, that I will deliver to you. However, most of the students were demanded till up to question number 6, and especially question number 6 was very high on demand. So on your demand, we have completed this particular question also, and shall meet you then in the next session. And question number 6 and 5th was in demand, to be very honest with you. So shall meet you in the next session with something new. And now we have carried out our promises, and kindly many students I have seen, sir, you have recorded this lecture in English, record it in Hindi. ऐसा ना बोले कोई भी, प्लीज ना बोले. इतना इंग्लिश सबको आता है. अगर इतना इंग्लिश नहीं आएगा तो फिर प्रोफेशनल कोर्स करने का क्या फायदा? और इसमें है क्या चीज, आपको सॉल्यूशन ही चाहिए, isn't it? तो मैंने हिंदी में भी बोल दिया है. अब ये मत बोलना सब कुछ दिया है, कंप्लीट कॉम्प्रिहेंसिव सॉल्यूशन और मोस्ट स्टैंडर्ड सॉल्यूशन मुझे कहने की जरूरत नहीं है. और कमेंट्स आनी चाहिए कम से कम. रिकॉर्ड ब्रेक अगर नहीं आए तो मैं आगे एक बहुत बढ़िया चीज देने वाला हूं, नहीं तो मैं वो नहीं दूंगा. अगर इसमें कम से कम 150 आपके कमेंट नहीं आए तो। मिलते हैं नेक्स्ट सेशन में।